as a value manager, we want to buy stocks that are cheap. Well, how do we get to buy stocks that are cheap with a big future? Is because they're in some kind of trouble. They're either overlooked, they're underfollowed, the cyclical nature of the market's moving against it. And it creates this opportunity. And as the stock gets cheaper in price, the dividend yield inevitably goes up. And a stock like Canadian Tire, I mean, the company's been around over a century. It's been in the stock market quite a long time. Got a lot of history. We can look back in history about how high this stock trades, how low this stock trades, what the average trading level is. So if from the lows on a stock to its average, we can get a decent return greater than average annual market returns, that's a great investment. And that happens from time to time on a Canadian Tire. In my 40-year career, I've been in and out of Canadian Tire a lot of times in the past. Once in a while, you do want it to look weak and give you an opportunity to own a great Canadian franchise. I mean, the company's ubiquitous. No American competitor can come into this marketplace. They've tried over and over again. There's 1,700 stores. The mythology, which is probably still true, is that, there's a Canadian Tire within 10-minute drive of 80% of all Canadians. As soon as there's a new subdivision, they throw in a Canadian Tire. And men who are notorious for not liking to shop, they love shopping at Canadian Tire. All the men in my family, my brothers, my father, they love shopping at Canadian Tire. So, it's one of those franchises that is unassailable in Canada. And once it gets weak, it's a great opportunity to buy, but you just have to have a longer term horizon than the next 6 months or a year.